All right, so we're back here with Jakub from MSCI, and we're talking about sustainable finance, and wanted to briefly kind of ask you about, 'cause finance is really broad, very complicated, especially for somebody like me who's not a finance expert. I kind of see things as broken down in different tranches, right? So on the one side, there's the investment side of finance, okay? So whether it's equities or bonds or things, there's clearly an ESG and sustainability perspective on that. Again, whether it's like sustainable finance in terms of specific types of investment classes or green or other types of sustainable bonds, et cetera. So if I'm an investor as an individual, as a fund, whatever, I can look for certain types of assets that I would want to invest in. There's that angle of sustainable finance. On the flip side though, I think a lot of what MSCI kind of helps companies with is understanding internally as they're running their core operations, as they look into the future, as they're consulting maybe senior management teams, how they need to maybe integrate some risk management or mitigation strategies from an ESG perspective as well. Can you kind of like describe those two sides of things and just kind of break down some of the perspectives that maybe an executive or someone in industry would need to look at or think about as they're looking at it from these two perspectives?
Yeah. I think that's a very important question to address because obviously companies would have different set of choices, let's say, compared to investors, right?
Sure.
So companies, they are generally speaking in, they are active or operate in certain industries. The chances are they maybe don't want to overhaul their entire business model from one day to another, so they would likely stay, in the same industry.
And I imagine, sorry to cut you off, I imagine from an external perspective, the way those outcomes are measured is also very different, right? Because like the way you would maybe assess a mutual fund or a bond or something versus the way the company and their ESG measures are measured or calculated would be very, very different.
Certainly, but no matter what, I would say that the very first step, whether from the corporate point of view or an investor point of view, is to understand what are the relevant risks and opportunities, in the given industry or for the specific company, based on its business model, right? Because, companies are also not, 100%, let's say, only involved in one activity or one industry. Oftentimes we have companies, who have operations across different industries and so on. So the very first thing to understand is what are the relevant, as I mentioned, risks and opportunities for the given business model. So to give you a more concrete idea, if you are, let's say, talking about anything related to waste, say it's even plastic waste, right? It's very different how a company that is perhaps involved in food packaging is managing its plastic waste, maybe trying to reduce the waste that they are producing and so on. And if a company that actually uses very little of plastic is addressing this, right? So it can be, part of CSR or corporate social responsibility if any company, let's say, reduce their use of plastic cups and so on.
Yeah.
But for companies that don't work with plastic as the main source of their revenue, it will likely have not very material financial impact on their operations. Whereas again, for that food packaging company that uses a lot of plastic, it's an entirely different story. And the same goes for things like use of natural capital, let's say use of water. Again, I don't know if the company is involved in agriculture or food and beverage business, right? Their use of water is absolutely key, to their operations and also their financial performance. Whereas for some other companies, it wouldn't be as critical, right? So the very first step is to really understand what are the key ESG related risks relevant to your industry and your business model. And of course, the companies then have to act on them. They can do it through different policies. They can have plans in place how to perhaps reduce their water consumption, how to reduce their carbon emissions, because of course maybe they don't want to pay high prices for carbon credits and stuff like that, right?
And so between these kind of two aspects, if I'm understanding you, we're talking about kind of the second area where it's like internal corporate finance, looking at how you operate, and then looking forward and saying, here are legitimate risks, maybe from climate, maybe from maybe social or governance related issues. And so therefore we need to consider changes to the way that we operate, not only because it might be the right thing to do from a sustainability standpoint, but also because there may be some corporate finance like cost or other type of risk factors related to that. Is that right?
Yeah, absolutely. I mean, all of these things they have a price to them, right? So as you mentioned, if you are talking about energy consumption, if you are talking about use of different natural capital, also if you are talking about the workforce, right, and how to
Or customers and their preferences.
exactly,
Yep.
right. So definitely, as I mentioned, like this influence goes both ways, right?
Yeah.
So it's how the company impacts or its business affects the environment and society, but also how these things affect their business. So usually we do see a price tag there, and especially if we are talking about this say financial materiality for the company's results. Of course, again, then the key thing is to understand what are the relevant risks that will actually impact their finance.
And I know it's really, really complicated, so we may not know the answer to this question, but do you believe, based on your work or the research at MSCI, that there is a correlation between profitability and sustainability for companies and their willingness to engage ESG risk factors?
Certainly. So a lot of our research is, of course, examining this relationship between sustainability and financial performance, because ultimately, that's one of the key considerations for investors, but also for companies themselves, right? So if I maybe start, very simply speaking, how we see this mechanism work, right? So let's imagine we have two very similar companies, and one of them, at least according to our assessment, is perhaps, paying more attention to and is managing their sustainability-related risks better than the other company, right? So everything else equal, this company should be, or its risk profile should be better than that one of the other companies. And as we mentioned, if in finance we are talking about concepts such as the risk-adjusted returns, right? So the lower risk, everything else equal, that company, it should be reflected in the valuation of that company and its securities, whether we are talking equity or debt. So that's very simply speaking. So if one company is addressing all of these risks that the other one is not, right, we would ideally expect that to reflect in their financial performance. But being more specific, maybe set this into a framework which we can test whether these assumptions really hold.
Yeah.
Right? So we developed this framework that we called transmission channels of how sustainability translates into both fundamental financial performance and finally also the market performance of the company's securities, as I mentioned. So we identified 3 channels through which this can happen or materialize. So the first one is what we call the cash flow channel. So our expectation is that the companies that, as I mentioned before, manage all of these risks well, they are overall better managed, right? That should reflect in their financial performance, right? So we would expect them to be more profitable. Maybe for credit investors, we would also expect them to have higher credit quality, right? Or be maybe less indebted. And so on. And finally, this should also reflect in, as we mentioned, the market valuation, right? So we would expect these companies to perform better in the market. Perhaps on the equity side, we would also expect them to show higher dividend distribution because they have more cash flow to work with, and so on. And these are all numbers that we can test, as I mentioned, right? So we can look at the fundamental performance side. So as I said, we can look at the profitability. We can look at all the financial quality ratios that I mentioned. And finally, we can also, of course, measure their performance in the market, right? And we do this, right, in many of our studies. And we did find that the companies which had higher ESG ratings, MSCI ESG ratings, so we can say, because our ratings measure the company's resilience to financially material ESG-related risks. So these companies with higher ratings, they would perform better on these metrics that I just mentioned. Of course, I need to put a disclaimer there that,
of course,
over certain time periods, companies, past performance doesn't guarantee future one, and so on. But generally speaking, and now I'm talking about really large sample of global companies, so we are talking about 1,000 companies included in our indexes. We would see this relationship that the highly rated companies outperform the lower rated ones on the things that I just mentioned. And that one is maybe maybe the profitability or the return side of things. But then, of course, there is the risk side, as we mentioned, and which could be even more interesting. So again, using the transmission channel framework that I mentioned, we say the second maybe channel through which we would expect sustainability to feed into financial performance is what we call idiosyncratic risk channel, right? So the company-specific risk.
Yeah.
So the assumption here is that if the companies, again, manage their ESG risks better, we would also expect them to be maybe involved in fewer, large-scale bad incidents, different controversies and so on, right? That can be related to good governance, right? They have good oversight of their operations. They
taking care of their employees, supply chain management.
Exactly. Yeah. They have good policies in place. They train their workforce on different ethical, issues, anti-corruption, and so on, right?
Yeah.
So just all of these control mechanisms, we would expect them to materialize in this way, that we would expect the companies to be less involved in different incidents and controversies like these. So again, that's something what we can test. That's also part of our research, monitoring the controversies that the companies get involved in. Of course, these can be across the three pillars of the ESG rating. We can have environmental controversies, right? Of course, there can be accusations that the companies are operating maybe in protected areas, right? And in not a responsible way. That can be related to the social side of things. So whether inside their workforce, there can be some incidents there, or also perhaps behavior towards customer. And of course, on the governance side, where we would look at things like, say, bribery, corruption, and so on, right? So we, again, do see that the highly rated companies, they are indeed less involved in such incidents. And we would also expect that, again, to be reflected in the numbers that we see in the market. So things like large drawdowns in value of their securities, right? So simply speaking, if we see huge dips in their stock or bond prices, right, which is often related to these incidents, right? You would usually not see a very large drawdown in value like that, if nothing major happened, right? So again, we can test this, and we do see that when we are talking about this company-specific or idiosyncratic risk, the companies that we believe manage their sustainability risks better do perform better here. And the last channel within our framework is the systematic risk channel. So here, simply speaking, the assumption is that these companies, again, they have stronger business models, so we would also expect them to go through the crisis periods better than their peers who perhaps, do not, don't have this round view of, all of the risks that affect them. So again, how we can measure that is through things like resilience of their earnings, right? Like how volatile is their bottom line, through different economic periods, right? In expansions and contractions. And again, in the market, we can easily measure that by the systematic risk. So how do they move in relation to the whole market, right? Because the market can go up and down, right? So the companies usually follow, but is it always more or is it less than the overall market? So are you more stable or more volatile than the entire market? And again, we would see that the highly rated companies tend to have lower systematic risk than the lower rated ones. So with this, I just wanted to say that, of course, we can start by maybe these shortcuts, like I think everyone can imagine, at least theoretically, how sustainability may feed into financial performance.
Yeah.
But we, of course, want to take it one step further and test the real numbers to see whether we see this impact or not.
Yeah, that's great. And so for all our learners out there, I think this is a really important thing. So as a business ethics professor here at the University of Hong Kong for the past 15 years, probably one of the most consistent areas of perceived pushback that I get from my students is often this idea that it's either profit or ethics, or in this particular conversation, profit or sustainability. And that's not really what ESG or even sustainable finance is about. It's actually quite the opposite in many instances, where we're talking about sustainability, not from the co-opt kind of only environmental context, but something that is sustainable over the long term. You can't have something that's incredibly risky and volatile that is going to be successfully sustained over an extended period of time. So I think, again, coming back to what you were saying, when we look at ESG, we look at sustainable finance, it's about creating economic models that work, hopefully for everyone, over a sustained period of time, that over, again, a lengthy period of time will mean more profit for companies, for investors, not less. So yeah, thank you for that.